The stock market can drop 50% and nobody will panic for long, because they are not trying to save your wealth, they are trying to save the machine. And right now that machine is selling you a dream called AI while draining the rest of the economy like a siphon. If you feel uneasy watching headlines about AI companies, crypto, gold, and bonds all wobbling at the same time, good. That discomfort is your brain finally noticing that the normal rules stopped working. This is not financial advice, this is financial education, and what I am about to explain is the dark logic behind why so many assets are falling together in 2026, even when people tell you it is all separate stories. You are living in the middle of a wealth transfer nobody voted for. AI is replacing jobs faster than the education slogans can keep up. Housing is detached from wages in the United States, the United Kingdom, Canada, and Australia, so a whole generation is priced into renting forever. Inflation came down on paper, yet your paycheck buys less than it did in 2019. Meanwhile, the stock market still spikes when powerful insiders want it to. That disconnect is not an accident. It is a design choice, and the design is now breaking. Let me start with something concrete. In the last few weeks of 2026, you could watch the same pattern repeat across completely different asset classes. Big AI names that dominated the narrative got hit hard, and it did not look like a normal correction. It looked like liquidity leaving everything at once. When liquidity vanishes, correlation goes to 1, and when correlation goes to 1, your diversification fantasies become decorations. So what is actually happening? Is it only AI? Is it only the market? Or is it something bigger? Something that drags stocks, bonds, crypto, and even safe havens into the same storm? Here is the part nobody wants to say out loud. Money does not move like a rumor. Money either stays liquid or it disappears. In bubbles, money often does not rotate to a healthier place. It evaporates. And the reason it evaporates is usually the same reason every historical bubble eventually fails. The thing that looks like profit turns out to be financing. The thing that looks like demand turns out to be credit. The thing that looks like value turns out to be leverage, and leverage always needs faith to survive. Now, you might think I am only talking about one hype cycle. You are not wrong to wonder how many times we have been told this time is different. In the late 1990s, it was internet infrastructure. In the mid-2000s, it was housing. In the late 2000s, it was sovereign debt. In the late 2010s, it was cloud and fintech. And in the early 2020s, it was AI, crypto, and passive income content that looked like freedom but mostly delivered despair. The technology changes. The mechanism does not. The mechanism is always the same. Someone sells assets that require future buyers to keep paying. When the future buyers blink, the price collapses. Let's get specific with AI, because AI is the perfect modern mask. It can absorb unlimited attention, unlimited capital, and unlimited excuses. According to widespread industry reporting, the AI race is not just about software. It is about chips, data centers, electricity, and contracts that lock in customers years ahead. So when big names report strong revenue, people assume the industry is healthy, but revenue is not profit and demand is not the same thing as cash generation. Big numbers can be built on timing, on prepayments, on bookings that are not yet real, and on financing structures that pass risk downstream until it finally hits somebody who cannot pay. This is why the headline tells one story and the balance sheet tells another. Nvidia, Microsoft, Meta, Palantir, Oracle, and others were all celebrated as the engine of the AI future. Then you saw sharp drops. In a short period, several of these names fell by roughly 15 to 40% from recent highs, depending on the ticker and the exact week. You can argue whether the market overreacted, but you cannot argue with the timing. The narrative that AI is unstoppable got whacked right when liquidity risk started to rise. And here is the pattern interrupt you should not ignore. When the market sells the future, it sells it because the present is breaking. The present is not breaking because code stopped working. The present is breaking because money used to fund the race started to cost more, or because the financing channel started to clog, or because a critical input became scarce in the wrong way. In AI's case, the bottleneck is not just chips. It is power. It is cooling, it is interconnect capacity, it is data center real estate, and it is the financial risk tolerance of lenders and investors. Picture a 32-year-old nurse named David in Phoenix. David works nights. He has a small emergency fund and a retirement account he trusts because he has been told index funds are boring and safe. In 2020, he starts hearing the same advice everywhere. Cut costs, buy growth, stay diversified. He listens. Then he watches his rent jump, his groceries jump, and his insurance costs jump. By 2022, his savings look the same on paper but feel smaller in real life. He keeps working. He never missed rent. He did everything right. Then in 2026, the AI boom reaches his feet again. His coworker says, just buy the AI stocks, everyone's making money. David hesitates because he hates gambling, but he also hates falling behind. He adds a small amount to his retirement account anyway, telling himself it is long-term. 2 months later, his account is down, and his employer announces a hiring freeze. David is not confused by the stock move, he is confused by the timing. Why does the market punish the companies that have the future, while his life gets tighter and his bills do not pause? Here is the answer. David is not being punished for making a bad bet. David is being punished because the AI capital structure is a machine that takes money from somewhere and returns risk to somewhere else. When the machine slows, it does not only affect shareholders, it affects employment budgets, insurance underwriting, pension allocations, and credit availability. It spreads through the system because money is not a magic cloud, it is a network of obligations. So let's move deeper. There is a specific dark mechanism behind the AI bubble theory that you should understand, even if you are not an engineer and even if you think you are too far from Wall Street to care. The mechanism is a pipeline of financing disguised as business. Chip makers and cloud providers look profitable because they sell to someone who has cash or who can borrow. But the borrower is not always cash rich. Sometimes the borrower is just forward financed. Sometimes the revenue is real, but the cash cycle is deteriorating. Sometimes the customer demand is manufactured through contracts that assume future funding, and sometimes the product is purchased not because it prints cash now, but because it wins political attention, secures government relationships, or maintains a competitive position long enough to raise the next round. A simple way to think about it is mining. In the gold rush, the real money often did not go to the miners holding picks. It went to the suppliers selling shovels, permits, and transportation. The miners could be broke, even dead broke, and the supplier could still win as long as new miners kept arriving. The supplier does not need the gold to be abundant, it needs the story of abundance to keep attracting labor and capital. The supplier survives on sales volume, the miners survive on actual output. When output fails, mining becomes a tragedy. When the story fails, the whole camp burns. Now replace miners with AI startups and enterprises, replace shovels with chips and data center capacity, replace gold with cash flow from real customer value. In 2026, the pipeline has a top layer of vendors that monetize the frenzy and a bottom layer of builders that are still fighting for their unit economics. When the frenzy cracks, the bottom layer suffers first and the top layer drops later, but both can drop at the same time if liquidity is withdrawing from the entire chain. And this brings us to the ugly part nobody teaches in beginner finance videos. A bubble can exist even if the top seller is making money. Let that sink in. Nvidia making billions in one quarter does not prove the downstream is profitable. It only proves the supply chain is currently selling. If you were to build an analogy, it is like a high-speed train station where ticket sales look great while passengers are stuck in a tunnel and cannot get to the destination. Ticket sales can be real. The journey can still be doomed. Now, in 2000, there was a famous internet infrastructure rush. Companies that sold critical equipment often soared. Then the financing dried up and demand collapsed. People forget the name Lucent, but the lessons never die. The companies that looked unstoppable were often using customer financing and extended payment cycles to keep revenue looking clean. When customers could not pay, the balance sheets turned ugly. The old story returned. Profit on paper, risk in reality. Here is your next pattern interrupt. The most dangerous numbers are not the ones you hear in headlines. The most dangerous numbers are the ones that describe how long it takes to get paid. When accounts receivable grows faster than the cash, you have a warning light. When inventory grows despite strong marketing claims, you have a second warning light. When contract commitments exist but usage is blocked by energy constraints, you have a third. In the AI chain, you do not just need chips to be available, you need the electricity and cooling to run them. You also need enough compute utilization to justify those expensive data centers. If GPUs sit idle because power upgrades take longer than expected, or because model training schedules are delayed, you get a scenario where costs are real and cash generation is delayed. That is not a minor issue. That is the difference between a company that scales and a company that bleeds. In 2026, there are growing reports that some data centers are facing capacity and power constraints. One executive in the tech world described warehouses of GPUs that could not be fully deployed because of electricity limitations. Whether you call it a temporary bottleneck or a deeper structural mismatch, the effect is the same. Hardware can be purchased, but cash only arrives when the hardware produces value. If value production lags, the financial system starts treating it like risk, and risk is what the Fed and the bond market finally respond to. The Federal Reserve may say it is focused on inflation, But what you feel is not a theory. You feel it through mortgage rates, through credit card APRs, through auto loans, through the cost of business borrowing, and through the availability of refinancing. Even when inflation stabilizes, purchasing power does not automatically recover. People are still living with the scars of 2 or 3 years where prices outran wages. Now think about how housing fits into this. AI requires power and capital. Households require shelter and stability. In the last few years, housing costs in major countries have detached from wages. That means household balance sheets are weaker. If households are weaker, consumer spending weakens. If consumer spending weakens, business revenue growth slows. If business revenue growth slows, debt becomes harder to service. If debt becomes harder to service, defaults become a conversation markets start to prepare for. And once markets prepare for default, they reduce liquidity everywhere. That is how you end up with AI stocks dropping while safe assets fail to hold like you were promised they would. Here is the second cliffhanger into the next section. When liquidity stops rotating and starts freezing, the AI bubble is not the only bubble that can pop. Data center financing is connected to retirement money. Insurance capital is connected to credit. Pension risk is connected to corporate debt. And the moment those connections wobble, you get contagion, not just in tickers, but in your life. So let's talk about the retirement and insurance layer, because that is where most people are most exposed and least informed. In 2026, the retirement crisis is not a slow boil, it is a ticking clock. Underfunded pensions exist in multiple countries. Social Security in the United States faces long-term pressures from an aging population. Many people respond by working longer, postponing retirement, or making smaller contributions than they should. That is the official story. The unofficial story is that retirement funds do not choose what they hold the way you do. Fund managers choose allocations based on benchmarks, risk models, and liquidity needs. You might think your retirement money is sitting quietly. It is not. It is underwriting credit, purchasing bond exposure, and allocating to financial products that depend on stable correlations. If correlations break, the risk managers do what they always do. They sell. And when pension funds and insurers sell, it does not matter that your goal is safe retirement. It matters that the sale must happen at the price available. That is why your account can decline even if you did not touch it. That is why passive can still be painful in a crisis. Passive does not mean immune. It means mechanical. Now connect that to AI infrastructure financing. There is a common model in tech infrastructure investment. A company builds a data center. A lender or financial intermediary structures leasing and usage contracts. The leases are then bundled, sold, or used to support financing. The whole machine requires one thing: predictable utilization and stable pricing for the service. If utilization drops or the price for GPU compute drops, the cash flow that supports the financial product breaks. And this brings us to the third pattern interrupt. The price of renting compute is not abstract. It is not supply and demand in a classroom sense. It has real dollar sensitivity. Reports and pricing observations suggest that GPU rental rates have fallen sharply in 2026, in some cases by around 40% over only a few months. That is not a gentle slowdown. That is a signal that the input market is oversupplied, or that customers are renegotiating terms because they sense overcapacity and leverage risk. When rental rates fall, a data center financing model can flip quickly from profitable to unprofitable. You have fixed costs like power contracts, staffing, cooling, maintenance, and depreciation. You have variable revenue like compute utilization. If revenue per unit of time collapses, the payback period stretches. If payback stretches, lenders start to worry about refinancing risk. If lenders worry, they tighten terms. If they tighten terms, the entire chain tightens. Now ask yourself a question you were not asked during any AI hype interview. If the compute rental price is falling, who absorbs the loss? The investors who assumed utilization would hold. The data center operators that cannot cover costs. The funds that own structured products. The insurers that underwrite credit. And eventually, households because cost of credit rises again. This is where AI connects to insurance markets and climate disruptions too. Climate risk is not just about storms and headlines. It is about property insurance availability, risk premiums, and migration costs. When insurance markets tighten, that means more capital allocated to losses and less to growth. That means fewer buyers for risky assets. That means lower liquidity. And lower liquidity means AI financing becomes harder, even if your local life looks unchanged. Open loops matter here. Remember the idea that AI vendors may look profitable while downstream is bleeding? We are about to connect that to the next financial mechanism, the way the system tries to keep AI funded even when the cash economics do not justify it. So in 2026, the question is not only whether AI has value, it is whether AI has enough value relative to the cost of capital to survive without constant financial support. When interest rates are high, you need either strong cash flows or subsidies or leverage tricks. And if the system is already strained by government debt, household weakness, and credit channel fragility, leverage tricks stop working as smoothly. Global debt exceeds $300 trillion across major economies. That is not a stat to impress you. It is a warning about how many promises are already outstanding. Every year, debt must be refinanced. Every refinancing requires buyers for new issuance. Every buyer requires risk appetite. When risk appetite shrinks, debt service becomes more expensive and defaults rise. Defaults can be slow, then sudden. Markets do not like sudden. They price early. Now look at the Fed's role. When the Fed adjusts interest rates, it changes the discount rate used in asset valuation. It also changes the cost of borrowing for everyone. But there is a trap. Even when rates stabilize, it does not restore the world to 2019. The damage to purchasing power stays. Wages are slow to catch up. Rent and food and insurance can stay sticky. That means consumer demand does not rebound instantly. That means corporate earnings do not rebound instantly. That means credit risk does not fall instantly. It only falls on paper until something breaks. And something breaks regularly. In 2020, it was the pandemic shock. In 2022, it was the inflation shock. In 2023 and 2024, it was bank stress and real estate risk in specific segments. In 2026, it can be AI infrastructure financing and the broader liquidity chain connecting tech to credit to pensions. Now, the darkest part of the story is how policy can respond. There is an incentive for the system to prevent a dramatic collapse because collapse would destroy wealth, employment, and political stability. So the system tries to reflate through refinancing channels, through asset purchases in different forms, through regulatory accommodations, and through liquidity tools. Sometimes the effect is that money stops flowing into ordinary households and starts flowing into the assets that preserve the illusion of stability. This is how you can end up with a weird market where headlines say stocks hit new highs while people report that their life is getting harder. That is not because the market is disconnected from reality. It is because the market is connected to a different group's reality. The group with assets can borrow cheaply against them. The group without assets cannot. The top 1% owns more than ever, and they can move capital faster than you can. Now let's extend the bubble mechanism beyond AI. You already know crypto promised freedom. In 2026, that promise looks different. Institutional ownership of crypto has grown. Regulation and institutional dominance have changed the behavior of the market. Many retail investors learned the hard way that decentralized does not protect you from liquidity risk. If stablecoin liquidity contracts or if exchanges face stress, retail selling becomes forced selling, and forced selling collapses prices quickly. The pattern repeats with different branding. Gold and Bitcoin can rise and fall too. Gold is often treated as a hedge, but it is also a portfolio asset that can get sold when liquidity is needed. Bitcoin, which once behaved like a rebellion against banks, increasingly behaves like collateral. In many cases, banks and financial institutions hold large portions through custody and investment vehicles, and retail exposure depends on how those institutions manage risk. Here is the third cliffhanger. When liquidity gets tight, the system does not choose between AI and crypto and gold. It chooses between stability and chaos. It will pull money into whatever channel keeps the plumbing running. Sometimes that channel is US dollar-denominated assets. Sometimes it is structured products backed by compute and credit. Sometimes it is government support. And when the system decides it needs those channels, other assets and other people become the sacrifice. So let's talk about the dollar and the mechanism you were never taught in basic economics. You might think the dollar is stable because the United States has the reserve currency status, but reserve currency status does not mean immune to debasement. It means the world uses it because it is backed by a legal and military and financial network that makes contracts easier to enforce. In 2026, that network is under strain from global debt, from political risk, and from the need to finance massive obligations. Now, the system's goal is simple. Keep funding flowing, keep the bond market functioning, keep the banking channel confident, keep investors buying enough of the future to avoid a sudden repricing. But when you push liquidity in one direction, you create pressure somewhere else. And if you look at what happens when the system fears that bond demand will soften, you see something important. Yield and price dynamics matter. The more difficult it is for new buyers to absorb issuance, the more the price of existing bonds can drop when rates are adjusted. That can create a self-reinforcing tightening of financial conditions. So while people focus on interest rate headlines, the real question is how quickly the system